Hello and welcome to Bo Raven, and in this video I'm going to talk about our cash flow improvement tool. Firstly, what I want to say is that what the idea behind this piece of software, which is developed within Microsoft Excel, it's an Excel spreadsheet template software, is that the idea is to look at your business in isolation. You can use it if you're about to start out in business to look at potential cash flows and how you want to set your debtor days and so on. But even if you're an existing business, the idea is to not look at your brought forwards or your carry forwards as such, but just look in isolation at what your sales are at the moment, what your cost of sales are, your overheads and so on, and to see the impact on your business of playing around with how long it takes you to invoice, how long it takes you to get the money in from your customers, and equally on the other side, how quickly you pay your suppliers for either your raw materials or products for cost of sales or your overheads and so on. So what I'm going to do is quickly run through. This is your data page here, and it's very quick and easy to set up, even if you don't actually really know how to use Excel. This is your data page, and flicking through the pages is quite easy. Down the bottom here you've got the data tab, the cash flow and profit loss tab, and the summary of benefits tab, so you can just quickly switch between those. To begin with, these will be blank without information in there, but then you put your own company name in here, and it's very easy. You just type in your company name. So I'll just type over it just to show you. So Test Company Limited. And then once you put your company name in there, that's what will appear at the top of all your reports. Then put in here your start date. So in this particular case, it's the 1st of January 2016. But of course, you put in whatever period you want to start your analysis of your cash flows. Moving down to the data, and notice each time a little box throws up here which helps you to know what to put into that box. The tool does come with a manual which will go through this as well with you, but of course you can always refer back to this video if it helps. So what I've done is I've put in our average sales of 20,000. And it is a matter of just saying what you are going to average on a monthly basis. It takes things down to the very simplistic terms. So if you're an existing business, look over your last 12 months, total it up, divide it by 12, and put that figure in. Of course, if your business fluctuates, it doesn't take that into account. But for this purpose, I'm not so concerned about the fluctuations, although that will have an impact on your cash balances, and I'll explain that a little bit further once we have a look at the reports generated from this information. So I've put in £20,000 for my average monthly sales. I've then put in my gross profit margin here, and in this case I've put in 55%, and that's a percentage figure, and it'll work on the basis that it'll be 55% of your net sales, and it's net of any sales tax. In the UK that's VAT, or sales tax in the country you're in. The next entry is my average monthly overhead. Again, if you're an existing business, look over your last 12 months and divide that by 12 and put your average in there. If you're a new business, you'll need to put in what you forecast that to be. And finally, in terms of numbers, in this cell here, to put in your average wages bill. If you are VAT registered, or you think you're going to be VAT registered, in this drop down box here, when I say VAT registered, that's sales tax, which is over in here, which is what VAT is in the UK, but you might be GST if you are in New Zealand, or sales tax in the US. And you select monthly or quarterly. I'm going to leave that at quarterly. And then in this cell, you need to let the system know when your first sales tax amount is due, within the quarterly, and that will affect when it sits on the cash flow. The next cell is to enter how much money you would earn if money was sitting on deposit. And what it assumes is that whatever your bank balance is, that effectively is what you'll accumulate there. Don't worry about transferring money to and from. It's just to try and get a gauge on how it will affect the amount of money you've got sitting or not sitting in your bank account, as the case may be. Now at the moment in the UK, certainly interest rates, or what you earn on interest, is very, very low. So I put in 0.2% there. It might be less for you, it might be more for you. So put what you feel you could earn if you had an amount of money sitting on deposit. At this point, even if you aren't borrowing, and this is where I want to show you the interesting fact about the way this tool works, put a percentage in this cell. So this is the interest rate at which, if you went to your bank today to arrange an overdraft facility or to facilitate a loan, that's the rate. Now I put in 5% in there, which is fairly conservative. It's about right. Of course, it depends upon whether it's secured, it depends upon the length of time you've been in business, and of course the bank. Even though interest rates are low, banks are still charging a reasonable amount of money. Now in theory, you'll probably end up paying more than that in the UK at the moment, but I thought 5% seems fair. And then finally, your currency symbol in this box here. Now I've got in pounds sterling, and then it would pick it up on these boxes here to show that they are pounds, and then equally on your reports you got pound signs there. So for example, if you are in the US or Australia, you can put in your dollar symbol, and notice all of these change to dollars to show you that that's what you need to be putting in, and then all of the top of your reports and the summary of benefits will show you that it's a dollar sign. I'm going to change that back to a pound sign. If you are registered for sales tax and you have to charge sales tax, and you can then claim it on your inputs, put a percentage in here of what that sales tax amount is. Now if you aren't VAT or sales tax registered, just put 0 in here, and then it just won't take account of that. Quite simple. So these have been put in at 20%, which is what it presently runs at in the UK. And then next to those three figures is the percentage of that amount. So in this case, you've got £20,000 net sales per month, average sales. The rate applicable for VAT or sales tax is 20%, and in this case it's applicable to 100% of my sales. It may be that you have some sales that don't have VAT or sales tax applied to. So let's say, for example, 20% of your sales are in the UK 0 rated or no sales tax. So in that case, you would put 80% in that box there. In other words, 80% of your sales, VAT is applied. And that's the same for your cost of sales. So this will work out 55% of that, £20,000 will give you your total cost of sales. And then 20% of that, and again, in my case, I'm saying 100% of my cost of sales is VATable. And then finally, with your overheads, again, I've gone for 100%, but you could quite easily change that to 80%, because in theory, you're going to have things like in the UK insurance, which doesn't attract VAT. So I'm going to reduce that down to 80% in this case. On wages, in the UK, we have what's called PAYE, or pay as you earn. And from your salaries, you get deducted tax and national insurance, and also on top of your wages bill, you have national insurance added. Now I've kept this simple and just said of the £3,000, so that's your gross figure including employers' national insurance in the UK, or if you have similar in your country, 30% of that represents payroll tax, or in the UK PAYE, pay as you earn. And then over here, it's how long it takes you to pay that. Now in the UK, you deduct it 1 month and you pay it the following month. So in this case, it's paid in 30 days. But if you click on the drop down, you can have it as cash, i.e. paid immediately, 30 days, 60 days, or 90 days. So I'm going to leave that at 30 days. The next box is to do with how quickly you either receive your money or how quickly you presently pay your money. Now at the moment, I'm going to say that this company is allowing its customers 60 days to pay. That's the terms that they set. And the orange cells are what you are looking to change it to. And you can play around with these things. And again, with these, you can do the drop down. So cash is that you get your customers to pay immediately. Well, of course, you probably won't be needing to use this program, but if you are playing around with things, you may want to say, well, okay, if I did 30 days or 60 days, but change that to cash, you might still want to have a play with it anyway. But if you're getting your money on an immediate basis, then as long as you are making a profit, you shouldn't have a problem cash flow wise. But in this, you can say that, okay, you're either 30 days, 60 days, 90 days, and so on. Now, I know some businesses do allow longer periods. So if you're presently 90 days, select 90 days. But in this example, I'm going to leave it at 60 days. Then what you want to play around with is, what if I reduce that to, in this case, from 60 days down to 30 days, or to cash, for example, get money up front effectively. So I'm going to say, well, okay, we're going to reduce that to 30 days. Now, with sales, I've also got an extra parameter here, whereby this is how long it takes the company to raise its sales invoice. Of course, a customer's not going to pay until you raise a sales invoice, unless, of course, like for example, Bow Raven, we sell online and people have to pay up front before they can download our software. But if that is not the case, and you do raise an invoice for people to then pay, that has a big impact on your cash flow. And I've come across companies in my time of consulting, and certainly when I had my chartered accounting practice, where people were taking long periods of time. I did have one case where a company was taking somewhere between 3 to 5 months to raise the sales invoices, and then allowing 30 days. Then they wondered why they always had a bad bank balance, or they were running at the limits of their overdraft. So I'm going to say that in this case, originally it was taking a month to raise the invoices after they've either supplied the service or the product, which is quite bad actually. And then again, in the orange cell, I'm going to say they've improved this to doing it immediately, or certainly within 24 to 48 hours after providing the service or sending the products to that customer. And you'll see that that is key for the business. You've got similar entries for your cost of sales or direct costs and your overheads here. So I'm going to assume in this case that this business was fairly new and couldn't obtain credit, or that it was choosing to pay cash. So it was paying immediately on supply or money up front, cash on delivery. So these are both set at cash, and I'm going to see how it changes by getting 30-day credit with its suppliers. Okay, so the orange ones are what we're proposing, those three there, changing those, and this orange one, and these ones are what the company does at the moment. So if I turn to my cash flow and profit and loss account, this is your summary of your cash inflows and your cash outflows, which will give you a final closing balance of your current cash flow position and your improved cash flow position. So if the business was run as it was, and like I say, looking in isolation of this 12-month period, forgetting any brought forwards, just sales that happen in that period, because it was taking us 30 days to raise the invoice and then another 2 months to actually receive the money, we're not going to receive the first amount of money until April 2016, even though we did the work or sold the product in January. And then we're paying out in cash, and it will tell you the summary down here, or immediately, our cost of sales or direct costs, our overheads, and our payroll payments, which here will split out between the cash, i.e. the net you're paying to employees within the month, and then you'll see here it jumps up to include the amount you're paying over to the government for the amount withheld PAYE in the UK, or however you have payroll taxes in your country. And then you've got your sales tax payments, and then interest income or expense, and in this case it's in brackets because it's an expense, because if in isolation, if you didn't have any cash in the bank, and this is where it highlights the cost of money if you like, you would have to run an overdraft here or borrow money to the tune of just over £54,000. Now, looking at the improved cash flow forecast, you'll see that because we've reduced down the time it takes to invoice, so we're doing it immediately, and we've also reduced down the time we allow customers to pay to 30 days, our first cash inflow is in February. So straight away we're getting money coming in, and also our first cash flows out is just our payroll, because you have to pay your wages straight away. But notice that we've pushed forward when we're paying all our cost of sales and overheads into the following month. So actually in the improved cash flow position, the only amount of money we need to borrow is reduced to 2,100, because thereafter we're in a cash flow positive. But the important thing to notice here is the improved cash position, the difference between what was happening before and what is happening now. And that gets to a significant amount by March, and it gradually increases as you go through. If we quickly look at the profit and loss account, you'll see that this summarizes the improvement in profit, and essentially the difference is in terms of the interest or cost of your money, if you like. So although we're not actually earning huge amount of interest on the money that we're sitting on deposit because of the way interest rates work, but because we're not effectively costing us in terms of, in this case, borrowing money, but you still need to think about the cost of money even if you've got money sitting there. That's your improved profit. Just so you know, this will forecast forward for 3 years, giving you your current cash flow forecast, your improved cash flow forecast, and then your profit and loss account in each case. And then there's a report giving you the summary of the benefits. So looking at your profit, your cumulative profit, year 1, 1,700, year 2, you've got 2,300, and year 3, £2,500. Now that's not significant in itself, but it's £2,500 extra you have in your pocket rather than in a bank. Now it may be that you can't borrow, you don't borrow, but it's important to realise the time value of money. In other words, it's better in your bank account than somebody else's. But the important thing is the cumulative cash flow balance. So by year 1, you've got a significant increase of £65,000. That's the difference between the two scenarios, and that gradually increases. You get your biggest kick at the beginning, of course, because that's where you've made the major change, and then it just improves slightly with the increase in profits. Now, what this cash flow improvement tool doesn't do is it doesn't take account of what you could do with that extra £65,000 that you've got in your bank account. Now it could be that you pay yourself a bonus or a dividend, but more importantly, what you could do with that money is to reinvest it and grow your business much faster. And you can see that this would give you a snowball effect of getting your money sooner. So you invest the 65 grand to perhaps in more advertising to get more customers, convert those into sales. You're invoicing them quicker than you were before, so you then get more cash in your bank sooner, so you can grow your business much faster and much better because you've got money in the bank. Now this cash flow improvement tool doesn't take account of that, but I wanted to demonstrate the difference between what it can make to your profit and loss account and what it can make to your cash balance, and then you can go away and start to think what you could do with that extra amount of money. So that's all I'm going to say today about our cash flow improvement tool, but I hope you've enjoyed that, and I hope that it will actually benefit you in your business. I'd love to hear from you, and thank you for listening. Bye for now.